So what's the smart way to use straddles and strangles for your overnight trades? Straddles and strangles are neutral option positions, meaning you don't care which direction the market goes as long as it goes. It needs to move a lot, but if it goes a lot up or down, you'll still make money. As you know, with SPY Tomorrow, we're generally looking directional, meaning we use signals to figure out which direction the market might go when it opens up the next day. However, there are times we're not quite sure. Maybe there's economic news in the morning, or we know there's earnings announcements after the close of the bell. Whatever the case may be, despite our indicator, we're not quite sure it's going to be correct, or it could go either direction. So we might want to take a neutral position. So let's talk about some smart ways we can do that. A straddle is generally buying a call and a put just in the money. For example, you might buy a call at $3 just in the money, meaning it has some intrinsic value. And then you might buy a put at about the same price, say $3. So your total trade is $600. So you need a big move to make money, but again, you don't care which direction. A strangle is the same thing, except it's less expensive because you are buying options out of the money. So rather than buying your call at the money, you would buy it out of the money, maybe 25% or 50% out. So that $3 option, maybe we look for a $1.50 call and then a put that's $1.50. So now your total expense is $300. For straddles and strangles to work consistently, you need to be in a high volatility market, meaning you know the IV is over 25 or 30, and even better, generally you've noticed that the market has moved overnight. That overnight gap has been at least 1%, sometimes 0.75%, sometimes higher. But the bottom line is it's not opening flat, because that's the worst thing that can happen when you're using straddles and strangles. Currently, we're in a very low volatility market, meaning the IV is below 25. Actually, most of the time it's under 15, and even recently it's been under 10, which means the market's not opening up or down very much, which means most of the time a straddle or a strangle will lose money. As you can see, during high volatility times, you can do very well with neutral positions. But as that volatility comes down, so do the profits. This doesn't mean the market doesn't make big moves during low volatility. The general rule is this: when the market is going down, volatility tends to go up. If it's going down faster, there's obviously a lot more panic, and so there's more volatility. However, as the market goes up, volatility tends to come down. Even if we have big market moves up, the volatility quite often continues to come down. So when volatility is low, that means the market is trending higher. When the volatility is increasing, that generally means the market's trending lower. As we just talked about, sometimes we know there's big news coming and we just want to take a neutral position because we really don't know which direction the market's going to go. However, we don't want to just blindly buy our call and put the night before to sell the next morning. We want to see if those premiums have been pumped up, because sometimes that happens, especially when there's highly anticipated news coming up, whether it's general market news or a specific stock. So take a look a few days before, see what the premiums are at for a specific expiration, and then compare that to the numbers the night before that big news. If it seems like those premiums have been pumped up, like maybe 25, 50, or 100% or more, I might stay away from that trade. That's because the market makers also know there's big data coming out and there's more demand for those options. And so they're going to protect themselves as well as possibly make a little extra money because of the upcoming news. So they will increase those prices, and by the next morning, after the news has been released, those premiums come down, they crash, and that's what's called an IV crush. But that doesn't happen every time, and sometimes you'll notice there isn't much of an increase in the premium, although you believe there's some big information coming out. Well, then take advantage of that. Go neutral and make a profit when the market moves either direction. So we have to be extra careful during low volatility markets. We have to be careful to watch the premiums to make sure they're not overly inflated to avoid an IV crush. And we also have to consider if we could have an IV crush anyway just because volatility is coming down. For some of you, you might remember the SPY S trade, which was an excellent trade, is an excellent trade during high volatility markets. It's very similar to the straddle or the strangle, except it has just a little bit more directional approach. But for the same reasons why a straddle and a strangle doesn't work as well in low volatility, we found the same was the case for the SPY S. As volatility came down, it just was not as effective. There are certainly smart reasons to use the neutral position of a straddle or a strangle, especially during high volatility markets or when you know that there is market moving news just around the corner. However, when volatility is low, definitely consider taking a look at your indicator. And although you're not really sure, you might as well point in one direction. Rather than losing money on both calls and puts, you might as well have a small position in one direction. Maybe a small directional, or a SPY A or a SPY Q trade, which will allow you the same idea of protecting yourself with the opposite call or put, but you're still directional in a way that you could make a lot of money if you're right, or you could protect yourself and minimize your losses if you're wrong. And that's what SPY trading is all about, and I'll see you in the next video.